Welcome to Retire Coast, where we discuss all things retirement, life on the Mississippi Gulf Coast, and your financial welfare. Bill Anderson, your host, is a serial entrepreneur having created many successful businesses and holds a real estate broker's license, speaks about personal experiences with each topic. Listen, learn, and improve the quality of your life.
Welcome back to Retire Coast podcast. We're going to talk today about income taxes, your income tax return, and in particular, for those of you who are seniors, I'm going to talk to you a little bit about an article, actually a series. There's two of them that were written on retirecoast.com's website in our blog. And that's about how not only to file your senior tax return for the year 2023, which has just passed, but it's also about how to strategize for the current year 2024 when you're in the preparation mode for your taxes next year. You want to get ahead of that, of course. So I want to discuss with you some of the major changes in the tax law that will affect you if you're a senior, and that is a senior that is over 65 years old, as indicated by the IRS. Now, there's a special form for you to use. It's called a 1040-SR. It's a form specifically for seniors, and it also allows for many of the other kinds of income and deductions that the regular 1040 form does, but this is an abbreviated form. It makes it a lot easier for many seniors, particularly those of you that are retired, that may have many fewer deductions, not as many things going on financially in your life as when you were employed. Now, hopefully, most of you will pay no federal income tax the year 2023. And the primary reason for that is the tax bill that was passed in Congress in 2017, which effectively raised the standard deduction significantly above where it was before. Now, the standard deduction for a senior couple that exists today is more than double what it was before the bill changed the law. And that's important because most seniors don't have a lot of things to deduct. So going through that whole keeping the receipts process, all of the nightmare of preparing your taxes basically all surrounded the itemized deduction form, which is not necessary for the majority of you now because you won't have enough deductions to get over that threshold. A few other things have changed by law, where that there's limitations on charitable giving that are tax deductible. So a lot of people would give money to charity in large part because they were able to deduct it. Well, that's no longer the case with most charitable deductions for the average person. And then medical deductions. That's always been difficult. You would think that you're spending more on medical than you ever did before because you're a senior, you're making all those co-payments, but it's tough to get over the minimum threshold to be able to deduct. And then when you do, often you will still fall within that window of the standard deduction, which is quite large, sitting at a whopping $30,700. Now, it'll be difficult for most people, even with taxes on their property and other kinds of taxes that they paid, plus deductions for interest, etc., to bridge that number. People that live in real high-cost states also have a bit of a handicap because that law eliminates deductions over $10,000 for any taxes that you've paid on property. So that puts just about everybody on the same level when it comes to using the standard deduction over filling out the itemized deduction form. Again, it's going to be a help to you. Now, one of the reasons that many seniors won't pay taxes is, of course, the standard deduction, which is quite large. It's also that not all of your income may be subject to taxes. Now, Unfortunately, this is also a time in your life when you're going to be taking money out of your IRAs and or your 401ks if you haven't converted those over yet. And as a matter of fact, when you're over 72, there's a minimum amount that you must take out by law. If you don't take that, there is a severe penalty for not taking a minimum withdrawal from your accounts. However, that minimum withdrawal is not particularly large, and even for many seniors, taking that minimum withdrawal out may put you in a position where you pay little or no taxes. For those of you that will be paying a little more in taxes, at least you should know that not all Social Security is taxable. The 85% rate is the maximum, so you get at least a free ride on 15%. And don't get me started on the reason that we're paying income taxes on money that we already have paid income taxes on. That is for your elected officials and you to discuss in the future. I will talk to you a little bit about how that tax change in 2017 improved things not just on the standard deduction, but also on the marginal tax rate. They lowered the marginal tax rate, which is very good because for some of you that would otherwise have to pay much higher taxes because you've withdrawn from your 401k or your IRAs, or you have a side business, then we're up to literally about $59,850 of taxable income where your rate would be 12%. Now, 12% is not a huge amount compared to where it was before the taxes were changed. And then the next bracket for many of you will be caught in that if you have a side business or something else is still far lower at 22%. The majority of you will be below 22%, but many of you will be in that 10% bracket, which is $15,700 of income that you're allowed to make before you pay anything above 10%. And again, 10% is lower than where it was before. Now, unfortunately, for those of us that are really interested in not paying more taxes than we want to, the bill I referred to in 2017 is sunsetting, which means that it's going to completely go away after the current year we're in now, 2024. It's going to be gone. So you get one more year of this benefit unless Congress reauthorizes the bill. The problem with Congress reauthorizing the bill is that when the taxes were changed for all of us, there had to be offsets so that the budget didn't grow out of proportion. It has anyway for all kinds of other reasons, but the point was to rearrange the tax code to make it more fair and easier, which they did. And one way they were able to reduce the taxes for the majority of us was to take that maximum deduction, which didn't exist for people who had large property taxes and large state income taxes and other kinds of government taxes, and reduce all that down to a maximum of $10,000. There are some people that may have had $100,000, $200,000, $300,000, and all of that reduced the amount of money coming into the Treasury. It didn't seem quite fair for people who are struggling, such as seniors. So Congress said, look, we're going to put a cap on that, as I mentioned earlier, that $10,000, and that's going to be across the board for everybody because that's plenty. And then we're going to take all that savings by not letting people just have an unlimited amount of taxes that they can deduct, and we're going to roll that back in a higher standard deduction for everybody else. And that's what happened. Now, what happens now is that Congress, many individuals who represent areas that are high cost, they want to eliminate that what they call SALT deduction, that $10,000, and they want that to go back to just unlimited. If that happens, it's going to entirely blow the budget. The deficit will explode because that's where the savings were coming in. So regardless of where you stand on that, these are the facts that we have to look at. So you may want to contact your elected officials and tell them that you like things the way they are. You like these lower marginal tax rates. You like the fact that there's a large standard deduction, and you want that bill reauthorized. Unless you don't. Maybe you're one of those individuals who would like to see a higher or unlimited cap on taxes that can be deducted. Regardless, this is not a political statement. These are facts. Just wanted to let you know about them. Now let's get back to how you can improve your financial situation regarding taxes. I mentioned to you the age 22 plus situation where you must remove an amount from your 401k or your IRA. We have a calculator on our website in the article, which is entitled Seniors Income Tax 2023 Deductions and How to File Them Now. You can find them at retirecoast.com. And then there are some calculators in there too, so you can kind of figure out what this is. It talks about what's called an RMD calculations and how you can figure out how much you're going to have to remove from those accounts. The good thing is that you can remove the money from those accounts, but if you don't need the money, you can put that money into a Roth IRA as long as you are complying with the Roth IRA limits. It just depends on how much you're taking out. If you're taking out less than the Roth IRA limits, then you're good. You're just moving it from one account to another account. And yes, you'll have some tax exposure, but there isn't much you can do about that because that's required by law. Now, what we're suggesting then is that you consider filing your tax return on the senior form and that you use our spreadsheet. We have a Social Security worksheet here so that you can determine at the end of that spreadsheet if you're going to pay taxes or not. And if you have a window there, in other words, you could have earned another $5,000 and still paid no taxes, or you could have earned another $5,000 and stayed within the 10% tax bracket, then you can withdraw even more money from your 401k or your IRA and up to that limit so that you can reduce the total amount of taxes that you want to pay. Now, I strongly suggest that you consider removing funds from that IRA or that 401k as early as possible with the lowest tax consequences. And one thing you can do is to plan ahead so that if you think you're going to earn, for example, $5,000 or $10,000 less than the total threshold to pay income taxes at all, then you can remove that amount of money each year without paying taxes. Or if you decide that the 10% bracket is okay with you, it's much lower than it could be. If you took out a big chunk, it might push you in the 22 or 24% tax bracket, and you don't want that. So planning ahead for removing those funds from your retirement program and then putting them back into a Roth IRA, that may be a great strategy, because if you open a Roth IRA, any money that you put in there will never be taxed in the future, and you can take it out anytime you want without a penalty. So both you and your spouse can open those Roth IRAs. Now, you may find that you're taking out more than the government will allow you to put into a Roth in that year. Depending on when you do that, remember there's always another year down the road. So you can put that money into a brokerage account, invest it in a money market or whatever you choose to, and then just continue to fill up that Roth IRA every year and continue to drain that account, because that IRA is never intended as a lifetime situation. The benefits to you for the IRA existed at the time that you worked so that you didn't have to pay taxes on it. Okay? Well, now you're going to have to pay taxes on it when you take it out. So taking it out earlier and taking it out at a point where you will pay little or no taxes on it is your choice. You have some control over that. So if you think in 5 years you're going to need a big chunk of that money, maybe $25,000 or $30,000 for a project or buying a house or helping a relative or something like that, then start taking it out now, dribbling it out at the lowest possible tax consequence. And now I'm kind of getting into our tax planning for next year, which is another article that we have on retirecoast.com. And that one is Seniors and Retirees Planning Income Tax Strategies for 2024. It kind of rolls in together. So you start out by going in and completing your tax return for this year, doing the best you can for yourself. Remember, the year sailed, so you can't really do a whole lot. You can, however, before April 15th, put money into your Roth IRA for last year. You're permitted to do that. You can't change your income for last year. That's already cemented. But you can make those changes going forward, as I said, in your tax planning portion. So I would suggest strongly that you pay attention to ways and methods to reduce your income taxes, and that you plan ahead, prepare your taxes for this year. If you feel you need to seek professional help, you can always go to the IRS website, which is on there, and the IRS is providing a great deal of information, including free help for many seniors. You go to the IRS website after reading our article. We'll tell you a little bit about how that happens, and then you can go in and get some free help depending on your income. And you may be able to use the IRS or just yourself. If you need tax advice or tax help, don't hesitate to get it from a CPA. If you have businesses, if you have a more complex tax return, I suggest you consult a CPA. Those individuals have a lot more experience, particularly, or an enrolled agent. Now, an enrolled agent practices before the IRS, and they have a lot more information about taxes. I strongly suggest that you go to retirecoast.com and read our articles. They are much more in depth than what I've mentioned here. There are calculators in there and other visuals that you can see, including charts that will help you along with your tax preparation and also your planning for next year. Sign up at retirecoast.com and you'll be notified when we've written new articles. We do a lot more of the financial articles in the first portion of the year because people are thinking about that when they're talking about their taxes and they're doing some planning. Also, you may want to read some of our articles that deal with estate planning. That includes wills, trusts. If you have a small business on the side, there's some information about that and how you can set up a 401k through your business and continue to save money. Our website is created to help you with all kinds of things dealing with your personal life, your personal finances, possibly relocating, maybe living on the beach. That's what happened with me, and I enjoy it, and you may as well. So please visit retirecoast.com for a lot more information about your financial life and things you can do in retirement. Thank you for visiting our podcast, and please return.